Welcome to Beyond the Stock Market podcast, a ground floor production. I'm your host, Brian Daly, CEO of Ground Floor, a private markets investing and lending platform with over $2 billion in investment volume. I've spent my entire career challenging industry norms, and in 2013, I co-founded Ground Floor with Nick Bargava to make private markets more transparent and open to everyone. This podcast features some of the sharpest minds in finance. Each episode goes beyond the headlines to unpack the evolving relationship between traditional finance and new opportunities. There are lots of new opportunities out there. We love talking about them on this show. Our guest, Jillian Murrish, co-founder and CEO of Pier Asset Management, knows about a lot of them. She's been in this realm for quite some time, and Pier is a leading investment firm in niche specialty finance. Prior to co-founding Pier, she served as executive vice president of capital markets at Patch Lending and began her career as an investment banker at Houlihan Lokey. Jillian brings extensive experience in capital markets and investment management. So welcome to the show. How are you doing today?
I am great. I'm so excited to be here. Thank you for having me.
You bet. I gave a brief intro, but let's start with you telling the audience more about your background and what led you to start Pier Asset Management.
So I can't believe I'm saying this. I co-founded Pier almost 10 years ago. So in a few months, we'll be at the 10-year mark. And I founded the firm shortly after the stint at Patch Lending running the capital markets practice. And it was really there where I actually sat inside a spec fin company that I saw where there were some inefficiencies. And there was a huge gap in deal sizes that were under 25 million. So Wall Street, the big institutions playing in the space, were competing and plentifully funding the $50 million, $100 million transaction. But when deal sizes were smaller than 25 million, it wasn't worth them lifting their pencil to do the work. If you have $1 billion to put to work, you're not doing the $10 million transaction. And talking with all the other peers that were running other spec fin companies in consumer verticals, small business verticals, litigation finance verticals, the commentary was the same across the board. I need a small $20 million credit facility, or I've got a niche product that doesn't have that much volume. I need a capital provider, and there's no one to be found. And so we started Pier to solve that 10 years ago. And we've been on that mission, serving these niche segments within specialty finance. And one of our verticals that we're most excited about these days is music royalties. And we're taking the same tack there. We're doing the small deal sizes that the large funds are overlooking and can't do simply because of size. And we're not competing against as many other firms to do it, which, works out more favorably from a pricing standpoint. So here we are 10 years later, still doing the same thing.
Well, congratulations on 10 years. That's a long run, a good run. And you were ahead of the curve on this stuff too. I mean, when you say specialty finance, I think a lot of investors hear that term. It's sort of a term that's used a lot, but I don't know that everybody really understands what we mean by specialty finance. How do you define it? And why do you think it's become such an attractive area for institutional investors over time? You guys are flying in underneath the big checks, but what's even led the institutions there in the first place?
Yeah, so, I think of specialty finance really as investing in niche cash flowing asset classes that sit outside of traditional corporate credit or real estate lending. So instead of lending to an operating business and getting repaid through cash flow from the company, a specialty finance lender can lend against a portfolio of assets. So in our case, we actually lend against financial assets. So royalty streams, loans, receivables, advances, or other contractual cash flows. And, I think the reason the asset is so attractive is that these markets are less efficient. It really requires specialized knowledge, hands-on underwriting. These are very particular niche assets. There's not large volume. And so, there tends to be fewer capital providers, and there aren't banks that are spending as much time in certain niche corners of this sector.
Yeah, that creates the opportunity. And then when you guys first got started, where did you get your start and how did you decide what to do first? I mean, you already knew sort of a form of residential real estate lending for sure. Did you start there and then grow out, or did you decide to go a different direction in the beginning?
Yeah, so I co-founded the firm with my partner, Connor New, and his expertise had been in consumer and small business lending, and mine was in
Perfect.
real estate.
Yeah.
And so between those three sectors, you really cover most of the niches.
Yeah.
And so, we spent a lot of time in like broad-based consumer lending, like back in the lending club days and, funding circle, small business loan days, and then obviously fix and flip loans with my background. And then from there, it's really, you can boil down like invoice factoring to a form of small business credit. At the end of the day, it's all a cash flow underwriting exercise and stressing those in as many which ways you can, providing probabilities and timing of these cash flows. And so, a lot of those kind of basic building blocks of consumer, small business, and real estate were what led us into a lot of the other more niche segments that we invest in today.
So if I'm understanding, it sounds like when you guys assess opportunity, you're thinking, first of all, does it fly under the radar of sort of the big capital sources? Because that creates the opportunity. And then you're looking at the cash flows and trying to risk adjust the cash flows and understand what could disrupt or enhance the cash flows on these investments. And you're really on a risk adjusted basis going to the places where you have the best kind of underwrite on that.
Absolutely. You
Yeah.
said it better than I could.
Well, I don't know about that. But when we get to the underwriting, so you've got cash flow. What are the metrics that tell you about the cash flows? Like how do investors think about that? I mean, I guess it's deal by deal, sector by sector, but are there certain metrics that you're paying attention to that kind of put a deal down the fairway for you?
Yeah, absolutely. I think, there's industry standard curves that you expect to see. So when you look at a prime consumer loan, you expect to see a certain level of defaults. If you look at a subprime consumer loan, you're looking at a different default level. And so it's really saying like historical performance of this type of portfolio. Is it behaving typically? Or is it behaving better? Is it behaving worse? And then when you look at that, you say, what are the reasons it could behave better? Ooh, those are real. Oh, those tailwinds should persist. That's something really interesting we can look into. Or, oh, this is performing below industry averages. Like that's a non-starter. Let's not even dig in on that.
Is it hard to get the industry average? Some of
Yes
these
and
areas?
no. Yes and no. It depends on the asset. Sometimes you have to take big, broad data sets, like all unsecured consumer lending, where they're great data sources like DVO1. They do incredible work in the space, giving, broad data sets and trends, and it can really be useful. And then you have to modify it. Okay, this lending product doesn't do a down payment. How would that affect, overall collections and length and duration? And so there's a lot of this modeling. That just comes with experience of seeing so many
Sure.
derivations of the same product.
Yep.
There's only so many ways you can cut a loan in advance or royalty.
Yep.
And that's one of the reasons we've been so excited about music is that there's so much data coming from these rich sources like YouTube, Spotify, Apple, all the DSPs. I mean, you get a data file on a song and look at what revenue it produces in a year. And that file will crash most people's computers because it has so many pieces of data. You're looking at
Wow.
every time the song's been played in every jurisdiction across the world, on every platform, every day. And so,
And that's the underwrite? I mean, that sounds like a really, computationally, a really heavy lift. That's fascinating.
it is, but it gives you a much better ability to predict future cash flows when there's such rich data history to understand how assets perform. So, yeah, music is one of those that caught Connor, but he actually, my partner, I need to credit him with this. It caught his eye first, and he's a data junkie, and said, "Gosh, there's even more data here than in consumer lending. I gotta spend some time in this
And
asset
that
class."
data is, how do you even get access to that data? I mean, if it's, I understand like Spotify certainly has a ton of data. Apple has a ton of data. Do they publish that? Do the rights holders actually get it and therefore they can share it? Is that how that works?
Yeah, the main source of data is really the distributor report. So, in specialty finance, a typical term that a lot of folks know is a loan servicer. That's a company that goes and actually collects
Right.
on loans on behalf of the loan owner and goes and calls the borrower, "Hey, you got to make your interest payment." In music, there's something kind of synonymous called a distributor, and the distributor is the firm that's tasked with going out and collecting all the cash that an intellectual property rights holder of music is
Interesting.
owed. So they go to the DSPs, they go to Spotify, YouTube, Apple, and they say, "Hey, send us in. Here are the payments that you should be paying us. Oh, look at the report that Spotify sends." And so as a rights holder, you receive a massive report from the distributor that can go into detail on the DSP specifically, which had some of the most rich data. So as a buyer of
Or do the
royalties,
distributors become a source of deal flow for you? Or not so much? They're more just sort of the information. I mean, where does the
it,
deal flow come from?
yeah. So
Always the issue in these specialty finance markets, right? It's like, okay, wait, you've spotted an opportunity. Where are the deals coming from? And deal flow really matters. So how about for you guys? How did you get your foot in the door there?
So for us, being in Los Angeles is critical.
Boom.
You need
Right.
to be in Nashville or Los Angeles to be a music buyer. You can be in New York. It's tougher for deal flow. Like all of the large funds in New York have presences in LA and Nashville. That's where you go to find the deals. That's where you're meeting the business managers. You're meeting artists. You're at events, meeting the accountants and the lawyers who represent these folks, these rights holders. And so it really started as scrapping around in our own networks within Los Angeles. It sounds silly, but like truly on the T-ball field, you have an agent at CIA,
There you
a
go.
dad of a kid, and like really it started that way. And
Wow.
then again, we're serving a deal size that's smaller than the large funds look at. And when you're offering a product to the market that, isn't consistent, someone hears about it. Oh, they'll actually buy something that's a $5 million purchase. Oh, they'll buy something that's a
So they
million.
refer it
Wait,
to
oh,
their friend. And
yeah.
in why are they selling their royalties? What is the reason that somebody on the other end of this, the seller of the royalty or the provider of the royalty, is willing to do that or interested in doing that?
I'll back up and give a brief commentary on like how this intellectual property comes to be, and then this will make more sense.
Yeah, great.
So when a song is created, you have a singer, a backup singer, you've got a guitarist, a record label, the business manager, the accountant. There could be upwards of 20 people who own a
Wow.
piece of the intellectual property of a song when it's created. So imagine the guitar player on a Bruce Springsteen song owns a piece of that song. That person dies and their son owns that piece of intellectual property. Like that, the heir of a famous guitarist could be the owner of a right that's going out to sell it. So everyone thinks generally, oh, why would the artist sell their catalog? Do they not believe in it anymore? This or that. Like it can be that. And it often is a lot of these other tangential owners of IP that have been in and around the song that aren't the
Wow.
actual artist themselves. So, there can be record label deals where a record label has a huge portfolio of a lot of different artists. It's a hard business to be in right now. Folks are needing liquidity for working capital. So
Got
if
it.
they own intellectual property of songs, that's a source of liquidity. There may be a smaller indie artist who says, hey, I'm ready to buy my first house. I need to get a
Right.
bunch of money for a down payment. I need to sell for $1 million to live in
Right.
this expensive city of Los Angeles. Um, and so there's just a plethora of reasons we can't even comprehend or understand why, but they just come out of the woodwork and folks need liquidity and need cash for their next tour. Hey, I just made a new album. I'm ready to sell my back catalog so I can buy a van,
Right.
spend on all the venues and get this tour going.
I
So
mean
there's a lot of reasons.
unsurprisingly, music is a business,
It
and
is.
businesses need working capital, and
Exactly.
frequently, the people who are running these businesses have everything they own tied up in it. And so I guess
Exactly.
it's not really surprising, and as entrepreneurs, we can identify with needing or wanting liquidity along the way. I mean, that makes perfect sense, doesn't it?
Absolutely. Yes. And again, like we said, tangential things like the recording studio who got a piece of a song. That's a business they're running and maybe they have a bunch of fractional rights in songs and they
Sure.
need liquidity for that recording studio. So there's it just the reasons continue
I
to
think those are
pop
really
up.
good examples. How do you think about losses? So you're advancing some money for rights to this stream for a certain period of time, I would imagine. Can you give me a feel for what's the holding period typically like? And then what do you expect the loss ratio to be, or what causes losses on those advances?
Yeah. So interestingly, music behaves in a typically in a very predictable way. So when a song is created, typically in the first year produces the most revenue it will ever produce.
Got it.
So years 1 and 2 are up high, producing the most revenue the other produce. It drops off a cliff to year 2, off a cliff to year 4. And by about year 4, you're pretty stable. The decay, it's called, from the next year to the next is very minimal, if anything. It could be flat.
Mm,
And so there's various ways to invest in music. You can act like a venture investor and invest in a song right as it's made before you have any idea what that revenue is going to look like. And wow, it made top startup here and you got a real big jump.
Power law.
Um, a scary place to buy is like 1 year after a song's created and it's starting to kind of jump off the decay. And you're like, well, how long will this decay go? And what will it be next year? And so investing early in a song's life feels a lot more like venture investing. We're much more interested in songs, typically in the 4 to 10 year age. You call it a song's
Interesting.
age. And we really like that because typically the artist is still actually going and producing music, which always gives a pop to the back catalog. So we own something someone made 4 years ago. They make a new album. People start listening to the old music too.
Oh, so
Um,
you're underwriting the likelihood that they are going to have another success.
no, we are underwriting that anyone who's still listening to a song years 4 to 10
You're
after
going to
it's been
listen to
made
it.
will continue listening to it. And whatever
Oh, so
that baseline
anything on top of that
vibration,
is
it's a pop.
it's a pop.
That's great. You
Upside.
can get a readjustment in your baseline curve. There
Wow.
are artists that may never make music again. We have an old gospel catalog and those bands are not together anymore. It's a
Okay.
30-year-old catalog and
Yeah.
that's just whoever listens to that still listens to it and it's
Yeah.
wonderful. And there's not going to likely be a pop. There's other sources of revenue, like sync, like if a song gets put in a movie or gets put in a commercial, that's big one-time revenue. And for any of the like investment banking, corporate credit junkies out there, that's like one-time revenue you have to normalize, right? You take that out of the stream
Right.
before you start pricing a deal. And music trades off of trailing 12-month revenue. So you
Okay.
have to normalize the revenue, then apply your multiple and purchase it. And if you're down here on a curve on the low part where the song has been around 4 to 10 years and the decay is very flat, applying a multiple to that, is much more predictable. You say, hey, should be the baseline going forward. The idea of thinking about like losses in this asset class, it's more like, did you miss on how fast the decay is happening? Like, was there more decay
But
than
if
you would
you're investing at year 4, you don't really, you've sort of selected out of that particular risk.
you should have selected out of most of
Right.
the decay. Like certainly. Yeah, that's how most music behaves.
And if you guys had to become like, tastemakers in music at this point, or you like, is there-
Well, let
are
me
you,
tell you, we own music I love, and we own music I can't listen to. Like, we are financial buyers at
right.
Pier. First and foremost, we look
Sure.
at the cash flow, look at how the decay behaves.
So give
So
me a sense, and then we can wrap up. I'll stop pummeling you with questions about this fascinating topic. But I love learning about this stuff, so I really appreciate you sharing. I mean, can you give me a feel for how broad is the catalog you own? Is and how broad do you want it to be, or is there an optimal size?
I think size really, as you're investing in asset class, comes down to pricing at deal size. So the whole thesis behind our business has been investing in these smaller
Right.
transactions that the larger firms overlook. And so we go in and we say, hey, we're willing to do the work on $1 million catalog. We're willing to do the work on a 2 million, a 500,000, a 5 million. And hopefully, again, as we said, by not competing against others, that allows us to have a little bit more pricing
Yeah.
power. I mean, we have thousands of songs. So
Oh, wow.
a catalog can have hundreds of songs in it.
Right.
You can buy a back catalog from a recording artist or a recording studio that has thousands of fractional pieces of a song. So we also have, larger banner assets that we like to buy that are like a single artist that people would know of. And then, there's no name indie artists that have a great smaller following. And so I think the name of the game, again, at Pier, like across all of our strategies, we always try to harp on diversification, whether that's genre, deal size, deal count. And like the easiest way to diversify is simply by having a larger count of deals,
Yeah,
that you're getting exposure
for
to.
sure. I love this. This is so fascinating. Great start to our conversation. Thank you very much. We're going to pause here. When we come back for part 2, we could talk some more about the market. I think it'd be interesting to get into for our audience. You can connect with Jillian via her LinkedIn, which we'll include in the show notes, or you can visit peeram.com. You can check out all episodes of our podcast at groundfloor.com/podcast. And we hope if you like what you're hearing, you'll like and subscribe in order to help us get more visibility for what we're doing here. Jillian, thanks for being here. And thanks everybody for joining us on Beyond the Stock Market.
Thank you, Brian.